Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer your questions. If you'd like to submit a question for a future show, I would suggest subscribing to the free newsletter. It goes out every Sunday morning. You'll find a link to it to sign up below this video. And in each newsletter, I include a link to a form you can fill out to ask me, well, anything you want. Also, we do a live show every other Monday night at 7 p.m. Eastern Time where you can ask questions. And for those that we don't get to, we add those to a spreadsheet as well. And I'll answer some questions from there as well. So let's dive in. I've got my cup of coffee. I'm ready to go. Here are the 5 questions we're going to look at today. First, why use a high yield savings account when money markets pay a higher rate, particularly Vanguards? We'll look at that. Is it better to invest in bonds in your traditional 401k or a Roth 401k? Important question. How do you differentiate between short-term correction and a prolonged bear market? That's a question of interest to a lot of people given the market volatility lately. 4, in retirement planning, what inflation rate should we use? And then 5, how can we educate our spouse or significant other about our finances? And the question here was focused on, a spouse or significant other that doesn't really have any interest in finances or investing, and I have personal experience with that question, so we will tackle it as well. So let's dive right in. And the first question, let me make it here. This was from Bob. He's from Ohio, so he's good people. That's just how it works. And his question was, although I have watched your videos on high yield savings accounts and on vehicles like Vanguard Cash Plus account and Fidelity Cash Management, I'm struggling with why one would use a high yield savings account, which seems to pay between 3 and 3.7% right now, instead of Vanguard VMFXX, which appears to yield 4.2%. Well, Bob, great question. Let's first take a look at this VMFXX. That's a Vanguard money market fund. And here it is. And sure enough, you can see, I looked it up. This is current. 4.22%. That's its current. They call it a 7-day SEC yield. And it's relatively inexpensive as money market funds go, 11 basis points. Now, keep in mind that expense ratio is already subtracted from the yield, so you don't have to make any further adjustments, but I do point that out. So the first question, I guess, is that actually, are there savings accounts that beat 4.22%? And I would only include, of course, FDIC accounts, that are insured by the government, and probably accounts that don't have any limitations or not significant limitations, because some bank accounts will pay a higher yield, but only on, say, the first $5,000. Maybe a perfect option for some people, but a lot of folks may want to include more money. So I went to my other site, allcards.com. I'll leave a link to this page below the video, but we're currently tracking 112 savings accounts. You can see that here. And we track about 1,000 CDs. But in any event, you can see, here's an example. This pays 5%, but only on balances up to 1,000. So we try to include any of the gotchas here. But as always, you want to check with the financial institution. But if you skip past sort of those accounts that have those kinds of requirements, here's Pi Bank, 4.6%. So you can actually do better than 4.22%. Now, I'm not familiar with Pi Bank. Let's go to it now. I think it's an FDIC insured bank. 4.6%. You'd want to do your due diligence, but they say they're a member FDIC. And so there are savings accounts that pay more. By the way, one of my favorites, I've never banked here, but let's see here. Yeah, the Redneck Bank. I mean, look at that. You get the squirrel going across the lawnmower. You've got the pig. I mean, this is, what's not better than this than having an ATM card with a squirrel on it? Anyway, the Redneck Bank pays 4.4% on up to 100 grand. So there you go. A lot of options that actually do pay higher than 4.22%. And we'll now get the squirrel off the page. There we go. I would say a couple of things. As money market funds go, it's hard to beat Vanguards. They are phenomenal. I do think, as we saw, you can find savings accounts that pay more if you're willing to open up an account at that bank. Keep in mind, you'd want to stay under the FDIC insurance limits. May not be an issue for a lot of folks, but for some of you, it might be. Now, money market funds are not FDIC insured, but if we go back to Vanguard's, just as an example, this particular money market fund is a federal money market fund. So it's going to invest in federal short-term debt So you'll probably get a break from state income tax, assuming it's in a taxable account, and it's not FDIC insured, but it's still backed by the government. Now, not all money market accounts are limited to just government issued securities, but even those that also invest in, say, corporate kind of securities, they're still incredibly safe. But I suppose if you were wanting the extra security of something backed by the federal government, you'd probably want to focus, for the most part, on a federal money market fund. By the way, Vanguard's not the only one that has this. You can find these at Fidelity and other places as well. But again, I do think VMFXX is arguably, if not the best, one of the best out there, certainly better than any comparable money market fund I can find myself at somewhere like Fidelity. Now, so having said all of that, the other factor I would throw in there is cash management. What are you doing with this money? Do you want to use an ATM card to be able to withdraw funds from this account? Do you want to be able to write checks, pay bills online? Now, maybe you don't, and maybe Vanguard is the perfect option for you. I will say you have to have an account at Vanguard for that money market fund. But if you're wanting more of an account that can almost act like a checking account but still get the high yields, in my view, Fidelity's cash management account is the best. Now, you don't have to invest that money in a Fidelity money market fund. You can, for example, invest in SGov. That's just one of many examples, which is an ETF that invests in Treasury T-bills, and you can earn a really good rate. In fact, I'll look it up real quick. Probably should have pulled this up, but let's look at it together. Let's just see what SGov is paying at the moment. And this is a fund that I do own, full disclosure. So its current yield, SEC yield, is 420, so just 2 basis points lower. It is it's slightly different fund. It's a 0 to 3 month treasury. So in theory, it's investing in bonds that mature a little bit longer than what you would find in a money market fund, but still incredibly safe. So you could invest in this fund, just as an example, inside something like Fidelity's cash management account and get a comparable yield. The thing to keep in mind, though, is that if you actually wanted to spend that money in something like a Fidelity cash management account through, say, writing a check, you'd have to sell your shares or some amount of it of SGov or some other investment and move it back into a Fidelity money market fund before you could then spend that money through writing a check or a debit card and the like. So great question, Bob. I do think Vanguard's money market fund is excellent. But yeah, there are actual banks that pay more. And I think there are some other things to consider beyond just the yield. As important, of course, as the yield is. But great question. All right, let's go to number 2. Is it better to invest bonds in a traditional 401k or a Roth 401k? Great question. So my approach to this, first of all, I like bonds as much as possible, except for municipal bonds, but your typical bond to be in some form of a retirement account if possible, because if it's in a taxable account, you're getting hit with those taxes every year. Ordinary income, it's considered ordinary income, and I'd rather shield that income from those taxes. So I do want it in a retirement account as much as possible. Between traditional and Roth, and this would be true whether we're talking about a 401k or an IRA, I prefer to put them in traditional accounts. Why? Bonds long-term are going to grow less than stocks, at least historically that's been true. And so I want my Roth account, which is going to be tax-free, assuming we follow all the rules, I want that thing to get as big as possible. I want it to grow as much as possible. So I want to put in it assets with a higher expected rate of return. So that'd be stocks. I would include REITs and a REIT fund in that sort of thing. That's what I want in my Roth account. In the traditional account, remember, eventually, unless we convert into Roths, but eventually we're going to have required minimum distributions, and the amount of those RMDs will be based in part on our balance in those accounts, right? Also, our age and life expectancy is part of that equation, and we have to take the RMDs even if we don't need to spend the money. Now, of course, we could take the RMD. All that does is pull it out of the retirement account. We could then, if we wanted to, invest it, say, in a taxable account. We don't have to go off and spend it, right? The IRS doesn't care if we spend it or not. But we do have to take it out, and of course, that gets treated as taxable income. And so if I'm going to have investments like bonds that have a lower expected rate of return, I'd prefer to have them in a traditional account, because when I think forward, it could be 10 or 20 or 30 years from now, but eventually, hopefully we get to that RMD age, better than the alternative, right? We'll have smaller required minimum distributions because we have the bonds in the traditional accounts. So that's my thinking on it, my approach, why I try to keep all of our bonds in traditional retirement accounts. All right, number 3. How do you differentiate between a short-term correction and a prolonged bear market? This is maybe one of the most important questions I've received in a long time. And I think the answer is you can't. It's impossible. There's no way you can do it. I can't do it. Warren Buffett can't do it. The best investors in the world can't do it. And at the same time, you'll find person after person after person predicting. They'll predict, they'll predict, they'll predict. And those news organizations that want you to click on their articles, click on their advertisers, watch their videos, they know that people eat up and love predictions. We want predictions. It's just like a moth to the flame. We just can't help ourselves. And when they give us these articles, they don't just say so-and-so predicted. That's not good enough. What they say is so-and-so, who correctly predicted blah, 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 pick your financial crisis, now says blah, 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 and they throw out another prediction. What the article won't tell you is, by the way, here are the 37 other predictions this person made, and they were just terribly, terribly wrong. We don't know. There's no way to know, and that's okay. So we have to make our investing decisions recognizing that we have no idea what the market's going to do tomorrow, let alone the next year. We don't know if this is a blip, a short-term thing like, say, the crash from COVID, and then stocks took off again, or is this 2000, 2001, and 2002 where we have 3 really bad years? We don't know. You don't know. There's no way to know. The worst thing we can do is think we know and then make investing decisions based on what we think we know. One of the hard things about that, by the way, is there will always be people that guess right. And you'll know because they love telling you. They will tell you that they sold out at just the right time. They're not going to tell you when things don't go well, but they will tell you when things go right. And that makes it really appealing. Anyway, that's my take on the question. I have no idea. I don't think anyone does. Okay, that was an easy one. Question 4. In retirement planning, what inflation rate should we use? Let me show you the question here. Hey, Rob, I've looked at the average general and medical inflation rates from 1968 to February 2025. The average rates are 4.05 for general inflation, and we'll call it 5.5 for medical. Almost everyone seems to use 3%, which seems to be low compared to the historical rates. Is 3% a wishful number? As you know, just a 0.5% change in the inflation rate makes a huge difference. Well, that's a great, great question. Now, when I first read that question, I thought, wait a minute, isn't the long run average 3%? He says 4%. And then I went back to the question. This is the key right here, 1968. Why is that significant? Well, if you're old like me, you remember that the 70s and early 80s had really, really, really high inflation. If we start the timing, if we say, well, what's the inflation rate been since 1982? It's roughly 3%. Now, that raises a question, should we make our assumptions based on inflation since 1968? Or should we base it on inflation since 1982? Or maybe some other date, right? And the answer is yes, no, it doesn't really matter. Here's the deal. What we're really trying to do is predict the future, right? And the fact is we don't know what inflation is going to be like in the future. Now, I do think it's reasonable to look at what's happened historically to get some idea. I look at, for me, I tend to focus on 3%, not because I want to exclude the 1970s, but because I can still look at a 30 or 40 year period where it's been 3%. But I have to recognize that that's just my best guess based on a somewhat arbitrary selection of time, right? I can certainly look at the 70s and say, well, if it happened once, it can happen again. Now, there were a lot of things going on then, going off the gold standard. What caused inflation? Vietnam War, that was a big a part of it. At one point, and I remember the gas lines, there was issues with oil crisis. And so there are a lot of things at play that we might argue are unlikely to occur again, at least in that combination of events to trigger a decade of high inflation, that might be true, but you know what? What's likely to happen are 18 other things that we can't possibly predict that might result in inflation just like the 70s and early 80s, or maybe even worse. The real key is we have to figure out how to plan in the face of uncertainty. We can use historical data, that can maybe be a benchmark, but we can't glue ourselves to the historical data. Whether you want to pick 1968 as a starting point or 1982, what I tend to do is run what-if scenarios. Now, this is not perfect because I could run what-if scenarios. What if it's 3%? What if it's 5%? And, well, what if it's 18%? Well, what if it's 38%? That sounds crazy, but hyperinflation is a real thing in different time periods and in different parts of the world. Just ask some European countries after World War I. I will say, and I'll show you this in Bolden. This is a demo account that I use, and I do think Bolden does a good job with this, and they've actually made some changes. So if you come to Bolden, this is sort of your dashboard. Again, this is all made up data, so ignore the fact that our chance of success is only 15%. We can come down here to rate assumptions. This is in beta, and this is where you input all of your inflation. And what this used to look like is this, where you could put in an optimistic number and a pessimistic number for general inflation, medical, the Social Security COLA, and housing appreciation. They have a couple of new options. One that I like a lot is the historical average. Now you'll see here, their historical average is 2.54% for general inflation. And you say, well, where in the world did they get that number from? Well, if we click this green button, you can see here, actually all their inflation numbers except for housing, they use the last 30 years, 1994 to 2024. But now, that's just one number. You can also toggle between a pessimistic assumption and, an optimistic assumption, which is 20% higher, and pessimistic, which is 20% lower. And you could think of those reversed in the context of inflation. But the point is, they're going to adjust it for you. And so, for example, if we come back here, I wonder if you can see, you can see the adjustments here. Optimistic inflation would be 2%. Pessimistic, in this case, is only 3%. But here's the point. You can change all of that. You can either come in here and manually change it. You can create a new scenario and with higher inflation and compare that with this scenario. With the optimistic and pessimistic, if we go back to the overview plan, you can just toggle. This was pessimistic. Let's see if optimistic helps. Well, we jumped to 43%. That's pretty good. And average takes us back down to under 15%. Again, made up numbers, so that's probably why it's looking so grim. But the point is, I like to play with these different numbers to get an idea of how sensitive my plan is to changes in things like inflation. You can do the same thing, by the way, on rates of return. We'll go to an account. Here's a retirement account. They have the same button and an explanation as it relates to rates of return. And you can use historical rates of return based on how aggressive your portfolio is. And so I think that's a very useful thing to do. And then again, you can play with the optimistic and pessimistic views. And then you can create new scenarios where you really get pessimistic if you want. Now, the last thing I'll say on this is, again, no matter what we do and what we assume, we can't know the future. So one question to think about is, retirement planning software, great. What if scenarios, got it, makes sense. But how do I protect myself in the real world? And there are a couple of ways we can do that. Of course, Social Security comes to mind because it's adjusted for inflation. And in that regard, delaying when you claim Social Security can be an excellent strategy, particularly if you're also concerned about the risk of living a really long time and how you'll fund your retirement. As you delay Social Security each month, up to age 70, you get a little bit more. Whenever you start claiming Social Security, it's adjusted for inflation. The other thing you could think about, and I think this can be particularly useful as you think about how you're going to pay for your necessary expenses, is a TIPS ladder. TIPS, Treasury Inflation Protected Securities, those are U.S. government bonds, and they are protected from inflation because they adjust the principal amount of the bonds by the rate of inflation. And so you get that inflation protection built in, and you could build up to a 30-year TIPS ladder. And we've talked about this in the past. I'll link to a video below this if I remember after I'm done recording this. But you can search for it in the channel where I've talked about building a TIPS bond ladder in the past. And in fact, a great site for that is this right here, tipsladder.com. Excellent. Highly recommend it. Free resource to build a TIPS ladder. But because they're adjusted for inflation, you can use that, maybe not to pay for 100% of your necessary expenses, although I suppose you could, after factoring in Social Security and perhaps any other guaranteed income. But even if it's just some of your necessary expenses, and then in that sense, at least for that investment, inflation doesn't matter. I mean, of course, it matters in the real world in our lives, but in terms of that investment, just like Social Security, it's going to be adjusted for inflation. And so that's a sort of a tool in our retirement toolbox that we can use to help, deal with the uncertainties of inflation. Okay, that's my take on it. Great question. And number 5, how can we educate our spouse about our finances? Well, another great question. I have had videos on what I call the blue binder. This is one video from 2 years ago. And you'll notice the orientation of the video is a little different than today. I've moved my desk from over there to over here, but there's something that really concerns me about this video. Remember, it was 2 years ago. Is it just me or do I look a lot younger? I don't know. I think I've aged something horrible. What do you think? I don't know. I don't think it's good. Anyway, I guess it's better than the alternative. You see this blue binder down here? That's my binder for our family. And I call it the blue binder because, the binder's blue. But if you watch that video, I sort of walk through what's in that blue binder. I've been doing an annual letter that I try to force my wife to read. At one point, we went to a coffee shop. She just sat there and read it and asked me questions. The other thing that can be very useful, and I talk about this in the video, I'm pretty sure, although it was 2 years ago, is that you can do recordings, not unlike the recordings I do here, where I show you my computer screen and whatnot. You can do a recording and even show your accounts. Now, I'd be very careful about the information, and keeping account numbers out and things like that. But you could walk them through your investment approach to investments. If you use a tool to aggregate your accounts like Empower or a lot of the budgeting apps today, like Rocket Money, for example, many of them, you can actually connect your investment accounts. Kubera is another one. But if you use something like that, you might even walk them through that in a video where you're showing it to them. Because depending on what you're using, you won't see your account information. You're just the name of the account maybe, but you're not going to see like account numbers and that sort of thing. And you could sort of walk through and explain it. And here's where you should be taking money from for retirement. And here's my investment philosophy. And here's why I have these investments in this account. You could walk through as much detail as you want. And then I think some kind of binder with sort of your end-of-life documents and just a description of how your finances and investments are managed could be very, very helpful to your significant other who may not have, a strong interest in personal finance and investing. So there you go. That's my take on it. I'll leave a link to that video in which I was much, much younger, apparently, below this video. Hopefully it will help you out. Well, great questions this week. Appreciate you sending them in. As I mentioned, subscribe to the newsletter and you'll see a link where you can submit questions for a future video. If you have any questions about this video, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.